Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests on the show. Joining us today are Sharmila, Joshi and Vivek Mavani, who are independent investment advisors, and T.S. Harihar of HRBV Client Solutions. Many thanks to all of my guests for joining me. Today on Hot Money, we discuss the results of SBI, India's largest lender, return to profitability in the fourth quarter. We discuss, is it the only PSU bank providing value for investment? The second one we also discussed was L&T. There was a marginal miss in the fourth quarter numbers, especially although the company has maintained its guidance for FY20. Margins, especially on the infrastructure segment, was a big disappointment. We discuss how should one play Tata Steel and how the company's deleveraging efforts will get impacted after the JV with ThyssenKrupp was called off. And lastly, we discuss IndusInd Bank result. The stock is corrected from levels of 1800 to just over 1400 in a matter of 1 month. We analyze what's weighing in on the stock and what's the way ahead. But let's start with the first one, and that's State Bank of India. Came out with numbers which were in line with estimates. The counter did manage to do well post the numbers, also has managed to react positively. Slippage is also coming in lower than what the street was anticipating. Asset quality was better, and as usual the management said probably the worst is over. Vivek, is the worst over for SBI?
Well, we would like to believe so. So it is after 5 years of management saying worst is over, worst is over. I mean, Q4 finally seems that yes, indeed, they seem to be coming out of the woods. So as you mentioned, lower slippages, some recoveries, and going forward, the way is significant recoveries being expected. I mean, almost to the extent of 38 to 40,000 crores. A large part, almost 16,000 crores from 3 large accounts, which is SR, Bhushan and Alok, all of 3 which are in advanced stages with NCLT. So hopefully in the next 6 to 12 months, at least that money should be flowing in. Going forward, what we do see is recovery both in credit offtake. In Q4, the credit offtake was in double digits, both on the retail and the corporate side, which likely to sustain. So the cost of, so basically what is going to drive the next 4 quarters is double digit credit growth, higher yield on advances, controlled cost of funds given the high CASA at more than 45%. You have lower slippages and hopefully better recoveries. Also, we need to consider the fact that in the last financial year, they have also taken hit on staff costs to the almost 38,000 crores on pension liabilities and gratuity, which is obviously not going to recur this year. So that also adjusting. All in all, it is well on track to achieve maybe about 14-15% return on equity and 1% return on assets for the current year. I think that would be the base case scenario. Probably they can do marginally better if the recoveries are better than what is expected. On the valuation front, at one-time price to book on a consolidated basis and expected 15% return on equity, it seems very, very reasonable. I think the stock can do 400 in the next, in a year's time, and maybe about 500 plus over a 2 to 2.5 year time frame. So I'll be positive on SBI, not just SBI, even some of the other large PSU banks, namely Bank of Baroda.
Okay, that's the view that's coming in. Thumbs up coming in on SBI, and also watch out for Bank of Baroda because that's what Vivek seems to be bullish on. Sharmila, what did you tell your clients after seeing the SBI numbers? Is that something that they should start accumulating? Did it show any kind of glimmer of hope that things are actually turning around?
Well, to just sort of, I don't really want to go through the numbers, but I think obviously, as you said, numbers did look better. Asset quality is seen improving, and more importantly, they don't seem to have an exposure to any of the new stress names that we hear about. And of course, I think among the PSU banks, this is definitely a preferred play because, and I think it has been. Even before the numbers, I would have said that if anybody had a buy or if anybody had a slightly positive view, it would have been on SBI. But what I think can really, and we've seen over the weekend, most brokerage houses have had a positive outlook on the numbers and on SBI going forward, and most of them have raised their target prices. What I think can tip the sort of the balance in favor of SBI is if they actually see a resolution to either the jet issue or any large, company where they are they're facing problems. Because I think it's all very well to say that they are close to a resolution, or in jet now we have some little positivity because Etihad has put it. But once it sort of is off, and it's done, I think that's when you will probably see a bigger re-rating for the stock. So I hope that happens this year. But I would really wait for that, because I think that could really signal a positive turn for a lot of the better PSU banks, not just SBI. But I would want to see that resolution in the bag, sort of, okay, it's done.
So as of now, you're telling your clients to focus more on the private side rather than PSU?
Yes.
Okay, that seems to be the view that's coming in. Hari, what's your sense on SBI numbers? What have you told your clients?
No, we like SBI at these levels as a kind of a low risk play. I wouldn't say it's a great buy, but definitely as a low risk play, I would believe that the potential returns do outweigh the risk at this point of time. The big positive, I think, as even Vivek rightly pointed out, there is a huge NCLT recovery that is due this year. 3 large companies that didn't happen last the financial year is going to get carried forward to this year. So I think that is the positive. We have only one worry on SBI, and that is that there are a lot of non-NCLT-able companies like Jet Airways and probably ILFS, where we don't know the exact size of the losses that these people are sitting on, and probably at some point, I think in this year, now that the NCLT has allowed banks to write off their exposure to ILFS, I think all that should start showing up. So probably I don't believe that the worst is over, but what I can see is that at these prices, at these levels, with the kind of a bounce back into profits they have shown, I would believe that the risk reward probably is in favor of the bank. So probably if you're looking at a banking portfolio, definitely SBI would be the one PSU bank that would be part of the portfolio.
Okay, so as of now, you're only positive on SBI as a PSU bank, no other bank on the PSU.
Yeah, not on the space.
And you're recommending private sector banks to your clients at this point of time, or are you cautious on the sector as such?
See, the private sector banks, I think, do have a major issue of overvaluation. If you look at the really solid banks with low NPS and good CASA share, like a Kotak or even let us say a HDFC bank, I think all of them have a problem of fairly rich valuation. So I think that is the problem. We are not too positive on buying into banks like ICICI and HDFC, ICICI and Axis, because I think the NPA problem out there is far from resolved, and we expect a lot more skeletons from the cupboard in these kind of banks. So probably, if you ask me, the banking space as a whole, it would be something like an RBL, a smaller private bank, and SBI on the PSU bank.
Okay, and before we go, Vivek, just a small question. Are you also following the same strategy, going for the private sector banks? I know in the past you've been saying that we would prefer an HDFC bank or a Kotak bank, but seeing these numbers and seeing some of the smaller banks like a Syndicate and all come out decent number, is your strategy changing towards a little bit of PSU banks?
Well, in terms of strategy of PSU banks, we continue to hold Bank of Baroda among the PSUs. Of course, we continue to hold Kotak as well. So Kotak is part of the core holding, added Bank of Baroda in the last few months. At about 300 levels, less than 300 levels in event of market correction, I would add SBI as well.
Okay, that's the view that's coming in.
At least I'll agree with Hari's view that the downside risk in SBI at this point of time is fairly limited. But the upside potential could be 30-40% in the next 1 year.
Okay, that's the view that's coming in from the first stock, and that is State Bank of India. The other company that came out with numbers was Larsen & Toubro. No doubt they met the guidance that they had said, at least in the last 5 years, they've been always missing it and cutting it. This time around, they met the revenue guidance, the order inflow guidance. But the concern and the reason why the stock is down in trade is because the margins, operationally weak set of performance, the margins disappointed on the infra side, and the guidance that they gave was maintained, and the street believes that it is still optimistic. And in an election year, probably they won't be able to do that. Sharmila, fair assessment. What did you make of L&T's number?
Yeah, absolutely. And I think the management also did say that, like last year, because they were getting into an election year, they knew that a lot of the orders would be front-ended. And now they know that once a new government gets in and it settles down, it will be only after that they'll get orders. But in spite of that, they've given an guidance, they've sort of maintained guidance. So I think that's a positive. The concern, of course, I think has been on the contraction in margins, I think 80 bips or something. But I think that is also really okay. And I think even if you were to drill down in the order book and see how they've really done, that also seems fairly satisfactory in terms of, the kind of projects they've got, which are the, sectors they've got the projects from, their export orders versus domestic orders, and, so on and so forth. So I think things are playing out as per plan, but I don't, so it's like a neutral view. I'm not, it's not a very big positive view on Larsen that's coming out. But I think that if you have it, you will definitely continue to hold it. And maybe if things begin to look a little more optimistic as we get into next year, maybe it could turn into a buy.
Okay, what about you, Hari? What did you make of the numbers?
No, I agree with Sharmila that we are also neutral to positive as far as L&T is concerned. See, I think again I wouldn't read too much into the fall in margins, because that is more because it's a mix of costs were higher. Also, I think they had some problems on the pricing front. So I think there has been a kind of a temporary downside risk that the company has had. What is good is that I think if you look at the order book overall, it's about close to 2,95,000 crores, close to 3 lakh crores. So I think that's probably a very, very sound order position. 25 to 30% coming from exports. That's again, I think, a very, very good diversification as far as the domestic economy is concerned. Our only worry on L&T is that if you look at the latest IIP numbers, I think the capital goods growth is showing at -9%. Now that is normally, if you look at it historically, not a very good sign as far as L&T is concerned, because their orders depend a large extent on the capital cycle. But considering that they have so many orders already on hand, that may not be a short-term risk for L&T. So as I said, we are neutral. We don't see too much of downside. But any upside, I think, would probably be over the next 2 or 3 years once the new government is in place, the new orders start flowing in, the costs get into place. I think only after that we'll probably get some positive
So
traction.
basically, I think most of the people we speak to on L&T, they say that we like L&T because there is no other alternative, at least in this space. Is that tag also slowly going away from L&T? People who move out of the sector because there's nothing happening. You spoke about the IIP numbers.
See, I think Tina is a fairly, I would say, dubious argument when it comes to buying a stock, because just because there's no alternative in capital goods, I can say I don't want to buy capital goods. So, and my logic would be, if the overall capital goods is -9%, then I really wouldn't use a Tina argument for Larsen & Toubro. But I agree that there is only one stock available. BHEL used to be a close competitor, but no longer. So to that extent, yes. But that would not be my reason. I would typically look at it as a good play on the overall infra space, neutral at best.
Okay, Vivek, have you got L&T into your client's portfolio, recommended L&T, or would you be concerned with what happened with the numbers?
Well, I'm neither concerned nor overly excited about these numbers. Yes, numbers were okay. I mean, a slight miss on revenue or margins was made up with higher other income, forex gains, as well as lower tax. So on the earnings, they still managed to somehow meet the expectation. Now, going forward, even their guidance or target for the coming year on order book may seem aggressive, but an 8 to 10% growth in order book, which itself is about 2.5 times annualized revenue, seems healthy. In terms of the projects where they have bid and the likely pipeline, assuming a certain win ratio, that is largely concentrated on the infrastructure side, power, T&D, most of it all by the government, either the state governments or the central government. And so that is prone to getting delays, where of course because of the general election, the first quarter is almost a wipeout. The new government will be in place only towards end of May, and by the time the cycle gets back, it will be probably not before the second quarter. But I am not overly concerned either. Simply because they have the strong visibility and likely improvement in Africa and Middle East as well. I mean, as Hari mentioned, 25-30% of the order book is from the overseas side. But on the valuation side, I don't see much upside in terms of expansion of multiples. So at best, you're only playing for the earnings growth, which in the best case scenario is probably 12 to 15%. No, I don't see L&T really in the next 2 years growing at a rate much higher than that. Now, for that 12 to 15% growth and 22 times earnings, I'm not overly excited about L&T. I mean, there are far better stocks to play with. Yes, I do agree with Hari that, okay, if there's nothing exciting in L&T or in capital goods space, I mean, one can well be out of the sector and not necessarily have that argument about because there's no other alternative.
Okay, that's the view that's coming on L&T. I think the consensus view is probably wait and watch for L&T, the cautious view of the management. Before I move to the next stock, Tata Steel, pull up the chart of Eicher Motors. It also came out with numbers, and the counter has corrected 7% today, post a slightly disappointing set of numbers, pretty much trading at the lowest point of the day. The next stock we want to talk about is Tata Steel, and an interesting development that came out. Finally, the street had the verdict that, once the announcement with ThyssenKrupp was there that this probably is the re-rating trigger that everyone was looking at. Focus on India, get out of the European market. But now a complete circle back to where the deal is no longer happening. So the big $3 billion debt which people thought will go out of the book is again back on the book. So what should one do on Tata Steel post the numbers? Remember, the counter has already corrected significantly post the correction, post the announcement that happened on Friday. But what's the way ahead? We'll ask Agash. Hari, back to square one of Tata Steel. Numbers were good. Everyone thought that the re-rating will happen. But now, again, you're at the same level you were 2 years ago or probably 1.5 years ago. At this level, what should one do?
No, I think what has happened in the ThyssenKrupp front is actually a big concern as far as Tata Steel is concerned. You know, when the Tata Steel acquisition happened about 11 years back, I remember talking to a fund manager, and you know, he was telling me something very interesting, that the European market is such, you know, it's like a chakravyuha. You can get in, but you can't get out.
Okay.
Now, that is a problem that Tata Steel is facing today. Because today, the kind of conditions that the EU is putting, it's becoming so difficult for Tata Steel to come out that their capital is stuck. Okay, they are stuck in a market that is not growing. They're not able to reallocate that capital to the Indian market. They have taken a huge debt, and they're sitting on a debt of about 1,25,000 crores currently. And they were hoping that once this happens, then we'll probably get out and repay part of the debt. But I don't think any of that thing is happening right now. Now, what's going to happen to ThyssenKrupp, I don't know. We'll get to know in the next few days. But as of now, at least it looks like that deal is over. Now, if that deal is over, I would believe it's a big negative as far as Tata Steel is concerned. Because short term, there are no triggers. There is no repayment of debt. There is no exit. There is no reallocation of capital. So if I think that deal is kind of totally out, then we would be negative on Tata Steel at these prices.
Okay, negative on Tata Steel, and as we speak, HDFC numbers are out. We'll have them on the screen in a while once our ticker team gets it. But Vivek, on Tata Steel, if we get HDFC, I'll just cut to it. But your comments on Tata Steel.
Well, I have actually little reason to be positive on Tata Steel for multiple reasons. But let me also put a disclaimer up front. I have...
Okay, let me just address it. 2,800 crores. That's a good number that's coming from HDFC at this point of time, and the spike up has happened. 2,860 crores net profit versus an estimate of 2,572 crores. Let's pull up the other numbers. If we can have the NII, that will be interesting to see, and what kind of asset quality that is there. That probably takes some time, but yes, at this point of time. Okay, let's see if we have any more comments. I'll ask my producer if we have any analyst, and we can go across to the analyst okay, so we'll continue with Tata Steel, and then we'll go to HDFC as in the next 4-5 minutes once we have more details. Yeah, Tata Steel.
So basically, I have little reason to be positive on Tata Steel. Not that I cover or have studied that company in too much detail. It's of very little interest to me to spend time and effort in doing it in detail, for basically 4 reasons. As Hari mentioned, they are large part of their balance sheet. The capital is allocated to a market which is not growing in the number one, and Tata Steel makes losses. Add to which they have almost 10-11 billion of overseas debt, thanks to that acquisition which they had done 11 years ago. So what you have in Tata Steel is only the domestic business, which is growing, as well as the cash cow, but that's an inadequate growth driver. Add to which, if you were to believe the trade war, any negative outcome of the trade war, slowdown in China, or global slowdown leading to commodities correcting and so on and so forth. I'm no expert on that, but if I were to even half believe that there are concerns in the global market, then Tata Steel really has no growth driver for the next, not just the coming year, but maybe for 2-3 years. It could be another lost decade, maybe a too far-fetched thought, but it has had a lost decade, last 10 years. It could well have another loss of few years in terms of where the stock goes nowhere, the company goes nowhere as far as growth in profits or growth in top line, bottom line. And we are now the huge question mark about deleveraging, because now you have a serious asset liability mismatch. If I can borrow the term from the financial services space, you have huge debt and no corresponding cash flows against those assets on the balance sheet of Tata Steel. So I continue to remain negative.
Okay, what about you, Sharmila? What's your sense on what happens now for Tata Steel?
So I think the development is a big negative, and you have concerns over what will happen with the UK piece, because Brexit itself is going through its own share of trouble, and then how will they monetize their assets in Europe now going forward once this falls through, because a lot of things dependent on this, because the entities would have come together and they would have been able to sell off some plants, etc., and bring down their debt. So I think all this is now a big overhang for Tata Steel. And in terms of valuation, actually, if you see, it has come down quite a bit. I think it's corrected significantly ever since this news broke out. So I think from that perspective, perhaps you could argue that it looks okay, because most of these commodity companies, it's come to that lower end of the band now. If you look at in terms of valuation. But I think until you get a little more clarity on how Tata Steel really intends to handle this situation, I don't think that there is any reason to really go out and buy the stock.
Okay, that's the view that's coming in on Tata Steel. Again, concerns still remain. The counter, however, is flat in trade, but remember, it has corrected significantly from the highs that we've seen. Still awaiting more details on the HDFC numbers that are there, but we'll move on. The last stock we want to talk about is IndusInd Bank, and the counter has corrected significantly. Whether it be concerns in terms of the IL&FS book or corporate concerns that are there, because the street generally tends to believe that some of the assets that Yes Bank had, even IndusInd Bank had exposure. What exactly is ailing IndusInd Bank, and what's the way ahead? So we will speak with I think the HDFC management will start to speak, but Vivek, till that time I'll have to cut you if that happens, but your view on IndusInd Bank.
Well, so to straight come to your question, what ails IndusInd Bank? Basically, it's a correction of valuations. After a stellar rally it had in between 2016 and till the middle of 2018, where the stock price had gone up more than 60%, and on a valuation at almost 5 times price to book sometime in 2018. So last year the book value was something like 400, and the stock price had almost touched.
Vivek, just let's cut to KK Mistry and we'll get back.
Everyone ready? Start. So welcome to everyone. The board has just completed the accounts for the year ended March 2019. So I'll spend some time running through some of the financial numbers, and maybe we can take a few questions after that. Our total loan book stood at 4,61,913 crores on an AUM basis, as compared to 3,99,511 crores last year at this time. The total loan book growth was on an AUM basis was 15%. But if you look at the individual component, and our focus in this year has largely been on individual loans, as we mentioned in the December meeting and we mentioned even in the September meeting, the individual loan book on an AUM basis increased by 17%. This year we have sold a significantly larger number of loans than we normally do. The total amount of loans we sold this year is 25,150 crores of rupees, compared to 6,453 crores in the previous year. The reason for the larger sale of loan is because of the sale of loans to HDFC Bank. As you know, we have an arrangement with the bank where the bank sources loans for us. We do the credit, legal, technical checks. We decide whether to lend money to a particular customer or not. If we decide to lend money, we make the disbursement, and then the agreement we have with the bank is they have a right to buy back up to 70% of these loans. Now, in respect of the previous year, there was a big question mark around the applicability of GST on sale of loans, and this is something which we had talked about last year. And accordingly, till the clarification on GST came, which came only in the quarter April to June of 2018-19, because of the lack of clarity, we did not sell any loans to in the previous year, in 2017-18, other than what was sold in the first quarter of the financial year. And therefore, the backlog of loans of 2017-18 was sold during 2018-19, which is the reason why the total amount of loans sold this year is significantly higher than what it was in the previous year. So therefore, the most appropriate way to look at growth would be on an AUM basis. If we were to add back the loans we sold in the last 12 months, then the individual loan book growth would have been 24%, and the overall growth in the loan book would have been 19%. As of 31st of March, we had a total of 54,601 crore rupees worth of loans, which have been sold by us, but which continue to be serviced by HDFC. So in addition to the loans that are outstanding in the balance sheet, we also have this 54,601 crore of loans which are being serviced by us. Our focus on the affordable housing segment continues unabated. During the course of this year, 37% of the number of borrowers who took loans from us would qualify under the EWS or the LIG segment. So it is 37% in numbers, but 18% in value. So 18% of the total loans we gave in the current year were to customers who were in the economically weaker section or in the lower income group. Our average loan size for borrowers in the economically weaker section is 10.1 lakhs, 10 lakh 10,000. And average loan amount for borrowers in the lower income group is 17 lakh and 50,000 rupees, 17.5 lakhs. Our overall average of loans that we've done in the current year stood at 27 lakhs. If we were to break down the loans outstanding on a balance sheet basis, on an AUM basis, between the different categories, individual loans constitute 74% of our total loans, construction finance constitutes 12% of our total loans, lease rental discounting loans constitute 9%, and corporate loans constitute 5%. So this is a breakdown on a balance sheet basis. If, however, we were to look at this similar number on an incremental basis, that is, we look at the loans outstanding on 31st March 2019, compare it with the loans outstanding on 31st March 2018, and then see how the growth has come in which component, which category, then you will see that the individual growth, the individual loans constitute as much as 85% of the growth in the loan book during the year. So individual loans constitute 85%, construction finance constitutes 10%, lease rental discounting loans also constitute 10%, and corporate loans actually are a negative 5%. So as we mentioned when we were declaring the results for September and December, our focus during this year has largely or significantly been on individual loans. We continue to reflect all the investments we have in our subsidiaries and in the bank at its original cost and not at fair value. The unrecognized gain, the difference between the market price of these investments and the price at which these investments are held in the balance sheet, that difference is as much as 1,87,386 crores rupees. This 1,87,386 crores does not figure anywhere in the balance sheet, but it is the underlying strength of the balance sheet because it reflects the difference between the market price of these investments and the price at which these investments are reflected in the balance sheet. The book value of our share on a per share basis, if you were to exclude the unrecognized gain on listed investments, stands at 451 rupees. And if we add the unrecognized gain on these listed investments, then the book value per share would go to 1,607 rupees a share. Capital adequacy, which does not take into account this unrecognized gain on the investments, is high. It stands at 19.2% against a regulatory requirement to hold 12% capital adequacy. Out of the 19.2% capital adequacy, Tier 1 capital stands at 17.6% against a regulatory requirement to hold 6% currently, and Tier 2 capital currently stands at 1.6%. So the breakdown of the 19.2% capital adequacy is Tier 1 17.6, Tier 2 1.6%. Gross non-performing loans were marginally lower than what they were in December. In December, the gross non-performing loans were 1.22%, and in March, this number stands at 1.18%. If we break down that 1.18% between individuals and non-individuals, individual gross non-performing loan number stands at 70 basis points, that is 0.70%, and non-individual non-performing loan stands at 2.34%. During the year, we have provided 935 crores towards provisioning, And on 31st of March 2019, we carried a total provision in the balance sheet of as much as 5,880 crores. This compares to a regulatory requirement to hold to have a provision of 3,220 crores. So as we have consistently kept doing over the years, we keep over-providing, we keep providing at a level which is higher than what the regulations require. We've been extremely conservative with our provisioning policy, and we continue to remain extremely conservative with our provisioning policy. Now, as you know, in the current year, we have moved to a new regime of accounting, which is the Indian Accounting Standard, INDAS as is commonly called. There are certain structural differences between the way INDAS accounts for certain items of income and expenditure and the way the old accounting standard looked at items of income and expenditure. So there is a reconciliation that has been given of the profitability of the previous year and the capital and the net worth of the previous year based on the old accounting standards versus what is applicable based on the new accounting standards. One of the differences between which the new accounting standard has imposed is with regard to income from securitization. When we sell a loan in the original scheme of things, the difference between the interest rate at which the loan was given and the interest rate at which the loan is sold, that difference used to come to the P&L account over the life of the loan. Under the new accounting regime, that income has to be, we have to first set aside a certain amount for expenses, and then the balance has to be accounted for upfront on a discounted basis. So for the quarter, the income that we would have earned on securitization was 66 crores of rupees, and in the previous year's fourth quarter, that income was 68 crores. So there's no material difference in the income on securitization fourth quarter of this year versus fourth quarter of last year. Net interest income stood at, now net interest income we have calculated with that securitization and without that securitization, and you obviously will have different numbers. So if we include the securitization income, then in the fourth quarter of this year, net interest income stood at 3,227 crores of rupees compared to 2,718 crores in the previous year, giving an increase of 19%. For the 12-month period, net interest income stood at 12,263 crores compared to 10,169 crores, giving an increase of 21%. But this is including securitization income. If we exclude securitization income, then for the quarter the net interest income would not be significantly different because there is not that much of securitization that has happened this quarter. The net interest income in that case would be 3,161 crores compared to 2,650 crores in the previous year, giving a similar increase of 19%. And if you look at the whole year, the net interest income for the 12-month period stands at 11,403 crores compared to 9,635 crores in the previous year. Net interest margin stood at 3.3%, but in the fourth quarter, if you look at the quarter in isolation, net interest margin was closer to 3.5%. Spreads slightly higher than what they were in the December quarter. December spreads stood at 2.26%, and for the year ended March 2019, spreads stand at 2.30%. So gross spreads stand at 2.30%, and if we break that between individuals and non-individuals, individual spread stands at 1.91%, non-individual spread stands at 3.17%. Now, the reported profit, I think, is very important for everyone to understand that the reported profit for the year is not comparable with the reported profit of last year because of the fact that in the previous year, in the third quarter, we had listed HDFC Life, and there was a huge amount of profit that we had generated at that time of that listing, which obviously has not repeated in the current year. And therefore, comparison of the yearly figure, the annual figure for this year will not be correct if you were to compare that with the last year. But it is possible to look at a comparison of the profit for the quarter. So if you look at the quarterly number, the pre-tax profit for the quarter stood at 3,691 crores compared to 2,602 crores in the previous year. This is on a pre-tax basis, giving an increase of as much as 42%. If we look at the whole year, the pre-tax profit stands at 13,119 crores of rupees. tax provision for this quarter is a lot higher than what it was in the fourth quarter of last year. The reason being that in the fourth quarter of last year, we were under the MAT regime, the minimum alternate tax regime, because of the lower tax that was applicable at the time of listing HDFC Life. So on a post-tax basis, our profit for the quarter stands at 2,862 crores of rupees compared to 2,256 crores in the previous year, giving an increase of 27%. Total comprehensive income is not significantly different from the PAT. Total comprehensive income for the quarter stands at 2,823 crores compared to 2,177 crores in the previous year. And if we were to consolidate our share of profits of the different subsidiaries and HDFC Bank, our share of profits, the consolidated profit for the year stands at 15,622 crores compared to 11,980 crores in the previous year, which gives an increase of 30%. So this is a broad summary of the results. The directors have taken the results on account and have recommended a dividend of 21 rupees for the year, of which 3 rupees 50 paisa has already been paid at the middle of the year as an interim dividend, and therefore there is a final dividend of 16 rupees and 50 paisa per share of 2 rupees. So the total dividend is 21 rupees per share of 2 rupees. So happy to take any questions.
We'll take questions one to one. We'll close. Sir, we'll take questions one.
Okay. Is that okay?
Yeah.
Thank you. Thank you very much.
Come to the floor.